If you invested 1 lakh rupees 20 years ago and just sat still, you'd be wealthy. But if you missed just the 10 best days of those 2 decades because you were waiting for a dip, your total profit would be cut by half. 50% of your future gone, not because the market failed, but because you tried to be smarter than the math. That is the cost of being Deepak. Deepak is an active disaster. He chases EV hype and just lost his savings in a battery fire stock crash. But then there's Kavya. She owned the exact same crashing stock, but she's currently on a meditation retreat. How? Kavya uses a structural shield. Today, we're dissecting the mechanics of wealth, from flexi caps to the 20% tax haircut the government takes if you can't sit still. Wealth is the reward for being boring when everyone else is panicking. Let's learn how to win the boring game. I'm Zoya, and this is the Zeering deep dive into the mechanics of wealth. Welcome to the deep dive. I'm Zoya, and I am thrilled to have you here today. Whether you're stuck in Bangalore traffic, ignoring a mountain of emails, or just walking your dog, you are in exactly the right place. Today, we're talking about wealth, but not the buy a course and get rich kind. We're dissecting the actual mechanics of money. Actually, it's more about the psychological and mathematical traps that wipe out even the most well-intentioned investors. Our mission? Finding the ultimate shortcut to building wealth without getting wrecked by the market. No pressure, right? I've synthesized a mountain of data for this. Forbes, Bankrate, behavioral research from William and Mary, the works. We're even looking at real-world market news from Electric and the Street. Real companies, real money, real heartbreaks. Because let's be real, we live in the era of FOMO, fear of missing out. It's a literal plague on our wallets. You open your phone and boom, the algorithm serves you a finfluencer flexing their overnight crypto gains or some next big stock. It creates this illusion that everyone is getting rich effortlessly while you're just sitting there, missing the boat. But the chasm between that perception and mathematical reality, that's where most people lose their hard-earned capital. So, to bridge that gap using data instead of emotion, I want to follow a financial showdown between two Gen Z investors. Meet Deepak and Kavya. They both entered the market on the exact same day with the exact same amount, 2 lakh rupees. Fast forward 3 years. One of them had a portfolio worth zero. The other, a compounding wealth machine. Their paths are a perfect laboratory for us. Let's unpack Deepak's strategy, or what I call the social media trap. Deepak is a smart guy, don't get me wrong, but he wanted a massive multiplier. He wanted to beat the market. He's scrolling his feed and he lands on this highly produced video of a finfluencer hyping up the next big thing. In Deepak's case, it was a single electric vehicle or EV startup. The pitch? It was intoxicating. Millions of views, comments flooded with rocket ships, people saying they're all in. Deepak hit a massive wave of FOMO. Now, putting your entire net worth into one unproven startup sounds reckless, right? But to Deepak, it felt brilliant. Why? Because of something called herd mentality. Humans are social creatures. We're hardwired for it. We assume the group knows something we don't. It's an evolutionary reflex. If everyone is buying, it must be good. Deepak saw that digital line out the door and his brain whispered, all these people can't possibly be wrong. It's like the restaurant analogy. If one is empty and the other has a line out the door, you don't even look at the menu. You just join the line. You don't check the health inspection score, you just want whatever they're serving. This collective wisdom is a trap, and it's weaponized by a second trap, the Dunning-Kruger effect. Deepak thought he was playing 4D chess. He thought he saw a shift before all of Wall Street. He felt like he had an informational edge. Spoiler alert, the market is completely indifferent to your personal conviction. Then, disaster strikes. Not a slow decline, but an overnight crash. A classic black swan event. The battery supplier for that EV startup issues a global recall. Total disaster. And because Deepak had zero diversification, meaning he owned nothing else, his entire portfolio took the hit. His 2 lakh portfolio absorbed the absolute maximum impact. When the market opened, the stock gapped down 40%. Just like that, 80,000 rupees, poof, gone in a single morning. It's a graveyard of hype out there. If you read the news, it's full of Tesla killers that ended up in Chapter 7 liquidation or bankruptcy. Take Ample, the battery swapping startup. Hundreds of millions in VC money, big partners, and they still went bust. Or Polestar, great revenue growth, but then boom, a going concern warning. Management basically said, we might not make it. So when Deepak dumped his 2 lakh into one stock, he wasn't investing. He was essentially playing the lottery. But here is where the psychological damage really starts. It's a trap called loss aversion. Neurologically, losing 80,000 rupees hurts twice as much as making 80,000 feels good. This pain causes investors to freeze. They refuse to sell because selling makes the loss real. It's the sunk cost fallacy. You focus on what's already lost instead of looking at what the company is actually worth now. Deepak kept saying, it's just a paper loss until I sell. No, Deepak, it's a loss, period. But hope is a terrible investment strategy. The company never recovered. Lawsuits, supply chain collapse, total wipeout. The emotional toll is the worst part. The shame, the regret, it breeds a sense of, I'm just bad at this. But wait, let's pivot to the alternate path. Let's talk about Kavya and the strategy that saved her. Kavya didn't pick a stock. She chose a flexi-cap mutual fund. Now, don't let your eyes glaze over at the word mutual fund. Let's do an ELI 5. Explain like I'm 5. Kavya isn't buying one car. She's buying a ticket to the whole fleet. She's putting her money into a massive pool. An asset management company takes money from thousands of people like Kavya. So, her 2 lakh is combined with everyone else's to create a financial behemoth. And this behemoth is managed by professional fund managers and quantitative analysts. These guys live and breathe data. They operate under SEBI rules, the referee of the Indian markets. SEBI defines companies by market cap. Large caps are the titans, the big banks, the IT giants. They are stable like big cargo ships. But Kavya chose a flexi cap fund, and this is her secret weapon. In a flexi cap, the manager has total freedom. They can move money between big, medium, and small companies dynamically. Compare that to a multi-cap fund. They are required by law to keep 25% in each category, no matter what. It's like a cargo ship where the captain is forced to keep equal weight on all sides, even if a storm is coming. But a flexi cap? The captain can unbolt the cargo and move it all to the safe side instantly. The manager acts as a tactical navigator. If they see a recession coming for small companies, they move to the big ones. So, Kavya's 2 lakh isn't just sitting there, it's being dynamically steered by experts. Now here is the kicker. Kavya's fund actually held the exact same crashing EV stock that ruined Deepak. Wait, how? Deepak is broke, but Kavya is chilling? It's all in the math of the structural shield. Deepak went all in, 100% of his net worth in one stock. That's not a strategy, that's a prayer. But in Kavya's mutual fund, that same EV stock was only 1.5% of the total portfolio. So, when the battery fire news broke and the stock plummeted 40%, what happened to Kavya? Let's run the numbers. 40% of a 1.5% allocation is a 0.6% reduction in her total value. But 0.6%. In the world of finance, that is basically background noise. It's a rounding error on a Tuesday afternoon. While Deepak's world was ending, Kavya barely noticed. And it gets better. Because she was diversified, her other stocks were actually doing the heavy lifting. While startups were struggling with high interest rates, the banking stocks in her portfolio were climbing. Meaning, her banking gains were literally swallowing her EV losses. This is sector rotation in action. Kavya was playing what researcher Charles Ellis calls the winner's game, by simply not losing. Because she didn't feel the visceral trauma of a 40% crash, she never felt the urge to panic sell. She just stayed disciplined. She stayed in the game. And that is the theoretical bedrock of her success. This isn't just luck, it's a Nobel Prize-winning concept by Harry Markowitz. Diversification is the only free lunch in finance. Now, you might have heard that high risk equals high reward. We've been taught that since forever, right? But Markowitz and Ray Dalio say, hold my juice. You can actually sever that relationship. You can lower your risk while keeping your returns. It sounds like magic, but it's actually just correlation. Think about it. If you buy Uber and Lyft, that's not diversification. They're basically twins. Same sector, same threats, same oops if the government changes a law. If one sinks, they both sink. The magic happens when you combine things that don't move together. Uncorrelated assets are the holy grail. Forbes did the math. If you have one high-growth stock, you're riding a mechanical bull. It's 40% volatility. But if you hold 15 to 20 uncorrelated assets, the risk of a devastating loss drops from 40% to 11%. You end up at the same financial destination, but without the heart palpitations every Tuesday morning. This is why it's called the only free lunch. You get the benefit of safety without paying for it in returns. The IBF Financial Knowledge Center breaks risk into two types, unsystematic and systematic. Unsystematic risk is idiosyncratic, fancy word for localized drama, like a CEO getting caught for embezzlement. Like our boy Deepak's EV startup, a specific battery fire. That is a risk you chose to take. And here's the kicker. The market doesn't pay you for taking that specific risk. There is no bravery bonus for being reckless. Wait, you're thinking, if I take more risk, shouldn't I get more pay? Not if you could have easily deleted that risk. If you can fix a problem with a simple mutual fund, the market isn't going to reward you for keeping the problem. Think of it this way. There's a massive difference between an expected baseline return and just getting lucky with an outlier event. Because any rational person can delete company-specific risk by holding a diversified fund, the market isn't going to pay you a premium for it. The only risk you do get paid for? Systematic risk. This is the global chaos you can't escape. I love the ocean analogy for this. You can't build a portfolio immune to a global shutdown. If the whole ocean drops, every boat goes down. But because you're willing to sit through those unavoidable waves, the market rewards you with a risk premium, aka long-term growth. Now I know someone out there is thinking, Zoya, I hear you, but I'm still gonna hunt for the next Tesla. Well, let's talk about volatility drag. It's the silent mathematical killer that finfluencers never mention. It proves why a portfolio that moves less actually ends up worth more. Let's look at the math because it's undeniable. Imagine you invest $100 into a high volatility, concentrated portfolio, Deepak style. If you lose 20%, your $100 becomes $80. Simple, right? Now a novice thinks, oh, I just need a 20% gain to get back to zero. Wrong. The math of percentages is asymmetrical. To turn $80 back into $100, you actually need a 25% gain. The deeper the hole you dig, the more the math works against you. It gets exponentially harder to climb out. If Deepak's portfolio fell by 50%, leaving him with 1 lakh, He doesn't need a 50% gain to break even. He needs a 100% gain just to get back to where he started. 100. While he's waiting for a miracle double up, Kavya's portfolio is already miles ahead because she never dug the hole. This is why standard deviation matters. A portfolio with high volatility, like 35%, is basically a mechanical bull. Over a decade, that volatility drag eats your returns for breakfast while you're busy trying not to get thrown off. The mutual fund structure isn't just a convenience, it's a math hack to avoid this specific trap. It levels the playing field for us regular people. But let's be objective, nothing is totally free. Mutual funds are highly engineered, but they do have friction. The big one? The expense ratio. This is the fee you pay the fund house to keep the lights on and the analysts caffeinated. I want to clarify how this is billed, because most people think they'll see a bill in the mail. Nope, the extraction is seamless. It's calculated into the net asset value, or NAV, at the close of every day. If the fund has a 1% expense ratio and Kavya has 1 lakh invested, she's paying about 1,000 rupees a year for that pro management. Then there's the exit load. Mutual funds are built for the long haul, not for your weekend impulsive trades. This friction is actually a good thing. It forces you to pause before you make a rash decision based on a tweet. And don't even get me started on the taxation framework. This is where the government joins the party. If you try to day trade or sell your equity funds within 12 months, you're looking at short-term capital gains tax. The rate? 20%, right off the top. The government takes a massive bite if you can't sit still. Wait, but look at Kavya. She's essentially the meditation retreat version of an investor. She held for over 12 months. Because she held, her profits moved into the long-term capital gains, or LTCG, category. Instead of that 20% haircut the day traders get, the tax rate drops significantly. It creates this massive disparity. It's a literal financial reward for just sitting on your hands. This is what we call the chill and hold methodology. No stress, no constant refreshing of your app, just growth. Kavya didn't have to be a genius. She just had to be patient. Everything, the math, the tax, the structure, culminates in what historians call playing the winner's game. I love the framework Charles Ellis uses for this. He explains the stock market using tennis. He noticed that in professional tennis, the pros win points by hitting incredible winners that the opponent can't reach. That is a winner's game. The outcome is determined by the actions of the winner. But he looked at amateur tennis, the kind we play at the local club on Sundays. In amateur tennis, points aren't won, they are lost through unforced errors. You just need to hit the ball back over the net and wait for the other person to mess up. This is a loser's game. The winner is simply the person who made the fewest mistakes. Ellis argues that modern Wall Street is now a loser's game for retail investors like us. Trying to pick the next massive tech stock? That's you trying to hit a spectacular winner against the pros. And the data on corporate survivorship is brutal. It's a reality check nobody wants. When you look at long-term market history, the mortality rate of individual stocks is startling. If you pick a single stock and hold it for 20 years, there is nearly a 1 in 5 chance that company will just cease to exist. Compare that to the structural resilience of a broad mutual fund. The likelihood of a highly diversified mutual fund plunging to zero is virtually non-existent. The fund is like a living organism. It constantly purges the toxic assets and adds healthy ones. It doesn't need to be perfect, it just needs persistent survival. As Harry Brown said, your goal is a fail-safe strategy. Don't try to be the hero, just don't be the victim. So, if the math is clear, the tax is better, and the survival rate is higher, why are we still buying lottery tickets? The answer isn't in your wallet, it's in your brain. It's cognitive dissonance and ego preservation. Our brains are incredible at selective memory. We curate our own financial highlight reels. We vividly remember the one time we made a quick buck and completely forget the 10 times we got wrecked. And the media doesn't help. They love the overnight millionaire story. They never interview the 99% of people who lost their savings trying the exact same thing. But let's get to the real reason Kavya achieved what I call financial escape velocity. It wasn't about IQ. It wasn't about outmodeling Wall Street or having some secret algorithm. Kavya just understood the assignment. The realization she had? That is the zenith of financial maturity. True wealth isn't about the thrill of the trade. It's about the acquisition of time and freedom. Deepak was chasing adrenaline. Kavya was chasing the ability to say no to things she didn't want to do. Let's synthesize the final takeaways here. Because the journeys of Deepak and Kavya gave us a masterclass. Lesson 1. Mutual funds, especially those flexi-cap ones, are an unparalleled defensive shield. They aren't just boring investments, they are highly engineered vehicles designed for survival. Regardless of whether you have 500 rupees or 2 crores, you face the same binary choice. The data is unambiguous. The psychology is documented. The blueprint for avoiding ruin is right here. But honestly, the hardest part isn't the math. It's the brutally honest self-audit you have to conduct. You have to ask yourself, am I here to make money or am I here for the ego boost of being right? Because the market will charge you a very high price for your ego. Just ask Deepak's empty portfolio. If you can shield yourself against the noise, the tweets, the hype, the moon emojis, you've already won. You don't need a 200 IQ. You just need a system that works while you're sleeping. And that's the beauty of it. You can build a wealth machine that is entirely in the background. No more heart palpitations on Tuesday morning. No more checking the app every 5 minutes. Imagine that. A world where your money grows and your stress doesn't. Now, I know some of you are still thinking about that EV startup. But Zoya, what if it had become the next Tesla? Sure. And what if I won the lottery tomorrow? We don't build lives on what ifs. We build them on probabilities. Deepak bet on a 5% chance. Kavya bet on the 95%. Who do you think sleeps better at night? Actually, don't answer that. The silence from Deepak's bank account says it all. So, as you go through your week, I want you to look at your portfolio. Is it a winner's game or a loser's game? Are you trying to hit winners or are you just focused on hitting the ball back over the net? Because honestly, in the long run, the person who just keeps hitting it back wins by default. You don't need to be a hero, you just need to be a survivor. The market is a marathon, not a sprint, and marathons aren't won in the first 5 minutes. Deepak sprinted, he's out of the race. Kavya is still walking and she's already past him. Building wealth is boring, and if it's exciting, you're probably doing it wrong. It's like watching paint dry. But when that paint is dry, you have a beautiful protected house. Now, we have to ask the million-dollar psychological question. If the data is this clear that broad diversification is the only free lunch, why are we still buying lottery tickets? Seriously, why do we ignore the math? The answer isn't in your bank statement, it's hidden in the wiring of your brain. It comes down to two powerful neurological mechanisms: cognitive dissonance and ego preservation. There is actually a research paper titled, "Why do so many investors keep playing the loser's game?" Spoiler, it's not because they're stupid, it's because our brains are incredibly skilled at selective memory. We are the directors of our own financial highlight reels. Think about it. We vividly remember that one random Thursday when we made 5,000 rupees on a tip. But our brains conveniently delete the 10 other times we got wrecked and lost 50,000. We curate the wins and bury the losses because admitting we were wrong feels like a physical attack on our ego. And the broader financial media ecosystem? Oh, they are incentivized to feed this exact illusion. Retail investors are subjected to a relentless barrage of narratives. This teenager made millions. This truck driver retired at 30. They detail the exploits of the lucky few, the outliers, but they never interview the millions who tried the same thing and failed. It creates this false sense of probability. You think, if they can do it, why can't I? But remember Kavya, her success wasn't predicated on possessing a 200 IQ. She didn't have to be smarter than everyone else. She didn't try to outmodel Wall Street or find a glitch in the matrix. She just accepted that she didn't know the future. That realization, that I don't know what will happen tomorrow, that is the zenith of financial maturity. True wealth isn't the thrill of the trade. It's the acquisition of time, autonomy, and freedom. Deepak was chasing a feeling. Kavya was chasing a life where she doesn't have to check a stock price to know if her day is good. She achieved financial escape velocity. She broke free from the gravity of market drama. So let's synthesize the big takeaways from our deep dive today. This is the cheat sheet for your wallet. The parallel journeys of Deepak and Kavya are more than just stories. They are architectural blueprints. Blueprint Item 1. Mutual funds are an unparalleled defensive shield. They are engineered for survival, not ego. Blueprint Item 2. Dynamic mandates like flexi-cap funds allow you to navigate storms without getting your hands dirty. Blueprint Item 3. You have a fundamental binary choice. Are you a gambler or are you an investor? The data is unambiguous. The psychology is documented. The path to wealth is actually quite boring. But boring is beautiful when it means you're actually getting there. The blueprint for avoiding ruin is accessible to everyone, whether you have 500 rupees or 2 crores. As we wrap up, I want to leave you with one final provocative concept to chew on for the next few days. Ask yourself this: if your portfolio was a person, would you trust them to take care of your family while you were gone? Conduct that brutally honest self-audit. It is the most valuable exercise you can ever do in the market. If you're still chasing the hype, you're not playing a game of wealth, you're playing a game of luck. And luck eventually runs out. Deepak's 2 lakh didn't just vanish into thin air. It was a tuition fee paid to the University of Hard Knocks. He learned that the next big thing is usually just the next big trap for people who don't understand probability. Kavya, on the other hand, graduated from the school of chill and prosper. Her journey proves that wealth isn't a sprint, it's a slow motion stroll toward freedom. But here's the thing, you can't be Kavya if you're still looking for the dopamine hit of a hot tip. You have to choose. Do you want to be right or do you want to be rich? Because often, you can't be both. Deepak wanted to be the guy who called it. Kavya just wanted to be the girl who retired early. And that choice is the only binary that matters in this entire 23-minute deep dive. The empirical data is unambiguous. The psychological vulnerabilities are exhaustively documented. The architectural blueprint for avoiding ruin is readily accessible. It's not a secret, it's just boring. But boring is what buys you the house. Boring is what pays for the vacation. Boring is what builds the legacy. We here at Z-Ring are obsessed with this. The real stories, the hard truths, the stuff that actually moves the needle. We're not here to give you hacks. We're here to give you a shield against the noise. Because the noise is loud, guys. It's coming from your WhatsApp groups, your favorite creators, and your finance uncles. Shield yourself. Shield your future. Because nobody is coming to save your portfolio but you. Whether you're starting with 500 rupees or you're managing 2 crores, the rules of gravity apply to everyone. Don't think you're the exception. Don't think you're the outlier. Just don't. Trust the structure. Trust the math. Trust the boring, dynamic, flexi-cap shield. And when you see the next Tesla killer on your feed, just smile, scroll past and go back to your life. Because Kavya is probably out there right now, walking her dog and not checking her app once. She's winning the loser's game. And honestly, it looks a lot more fun than whatever Deepak is doing. We're wrapping up this deep dive. but the conversation doesn't have to end here. I want you to take that provocative concept I mentioned earlier, the family audit. Look at your investments. If you weren't here, would this portfolio take care of your people, or is it just a casino ticket? Do that audit. Be brutally honest. It's the only way to transition from a Deepak to a Kavya. Thank you so much for joining us for this incredibly thorough deep dive. I hope you walk away feeling significantly more shielded against the noise and the hype. Stay disciplined, stay diversified, and most importantly, stay boring. It's the only way to win. I'm Zoya, and this has been a Z-Ring production. I'll see you in the next deep dive. If you want to learn how to build a portfolio that survives the noise, hit that like button, subscribe to Z-Ring, and follow us for the actual mechanics of money. Wealth is the reward for being boring when everyone else is panicking. Let's learn how to win the boring game. I'm Zoya, and that was your Z-Ring deep dive into the mechanics of wealth. Take charge of your future. I'll see you in the next one.